Rob's Child here with Security Analysis, Chapter 31. Nothing I say is investment advice, and I have no intention to replace any content of this book, but to talk about it and open it up for discussion. So, Chapter 31 is titled Analysis of the Income Account, otherwise known as the income statement, I believe we call it today. But I like to give this chapter another name too. I like to call it 50 Examples Why You Shouldn't Trust Earnings. Particularly with investment trusts, insurance companies, and banks. So, in a nutshell, that's pretty much the whole chapter. A few important points out of here are that I don't know if this was written after the Investment Company Act of 1940, but either way, regulations and rules have changed for these kinds of things many times in history since this book was written. And so I do think a good amount of the part referring to investment funds is antiquated and no longer relevant. But we will go through the points of the chapter anyway. So we start by talking about really it's just the problems that you can have with earnings, the problems that come up with seeing an earnings number and believing it or not, in a nutshell. So we start by saying how balance sheets, for example, are helpful because they're less volatile than earnings. Earnings alone exaggerate instability, even when a company has been doing great for decades and is clearly going to do great for more decades. Costs of certain things can go way up, way down. Competition can come. The building can burn down. Recently for AT&T and Verizon, they had that problem with the lead in some of their wires or something, and something that you're going to have to deal with to some degree. And so, earnings give a sense of instability, whereas he says the balance sheet doesn't really do that as much, and he shows some examples of that. He mentions to really understand the income statement, you need to see the start and the end of the period. To whatever that means, maybe like when I look at the charts, I think it might be like quarter to quarter kind of a thing. So you see like what they were before and then what they are now. I think that's what he's referring to there. He refers to Wall Street method of stock analysis, an equation on page 402, basically price equaling earnings times the quality quotient. And I'm sure we're going to get into that more, but he says in earnings, in this analysis that Wall Street does, basically he says there's too much emphasis on the earnings coefficient because the coefficient relies a lot on the trend. And so that quality number usually just means, what's been happening in the past. Just to bring up another funny point regarding that I think is really funny, I use this app called Webull, I think. Yeah, Webull. And it's hilarious to see how analysts have predicted the future price of a company and how it relates to earnings and all of that, and how unbelievable the amount of volatility basically involved is just, it's crazy, and it's true. I think this still greatly applies to today, that when we see the trend of earnings, for example, going up a lot year over year, we expect that to continue. I've mentioned this point in some of the other chapters, and so, this is one of the first things to be especially careful about when you're interpreting earnings. So now, then we start diving into the bulk of the chapter here with, he says, basically that the earnings can be manipulated and they can be arbitrary. They can be manipulated specifically in 4 different ways. First, they can allocate items to surplus or income, and he goes on ad infinitum about this point throughout the chapter, where companies will, it's either you should put it all in the surplus or all in the income, and they go back and forth to try to make the company look better to keep the stock price higher, and they've done that. I don't know how much that's done today. I imagine there is quite a bit of accounting and bookkeeping manipulation that happens to influence investors. I'm absolutely sure it still happens today. Maybe we have more regulation, but I digress. Number 2, the over or understanding of amortization and other resource charges. And so, so that's a tricky area regarding earnings for people that can manipulate the price. And he says the third one is varying capital structure. And so I think that might be referring to the types of how 2 of the same company can have 2 different debt structures, I think. Please correct me in the comments below if you know better. Please, I beg anyone that's watching this, just comment anything about this chapter, really. I'd love to turn the space into a discussion. All right, and then the 4th one being capital funds not used. Capital funds used not employed in the conduct of business. So, I don't know if it's a relevant example of Tesla building Elon Musk recently a glass house, but that's not part of the business. So maybe that has a way of manipulating the earnings too. I'm not really completely sure. Anyway, we're gonna move on. He says, interesting point here. About a deep analysis of a company, where he actually criticizes he basically says, why bother do a deep analysis? Because he doesn't say that, but it's important to understand that if you do the deepest dive into a company that you possibly can, by the time you read that information, something may have changed. Huge things may have changed. And, that snapshot that you are looking at is just a moment in time. And not only that, another problem with deep analysis is that you can't know everything. You can't uncover every single leaf of a company and understand it completely thoroughly. It's pretty much, I think that's probably pretty much impossible. All right, and then we move on the income account, or income statement, I believe is the word here. And he says to be careful with non-recurrent profit or loss. Talks about this a lot. Operations of subsidiaries or affiliates, which let's not speculate. And the third one being careful with reserves and what's in the reserves, what they're doing with what they call reserves. All right, and then we go on to a point: income or surplus is a lot of time ends up, like I said at the beginning of this video, it ends up being a choice where the accountant feels like putting it. Should we put it in the surplus or should we put it on the income? And so we'll get into that more as we get through the chapter. We make a point about how amortization can be confusing. And then I have a note here that says most of the rest of the chapter is this next following point. Basically, the sale of fixed assets sometimes add to earnings, and that this can hurt the investor's ability to track past and future earnings. And so then he has like so many examples. It's like just example after example. But the first one he talks about is the sale of a spin-off company being highly manipulative because they counted it, or they hid the special loss in the surplus instead of in earnings, like the spin-off profit. That doesn't make sense. Oh, right. So the spin-off profit was basically they cooked the books. I don't want to bother thinking through it. They sold the company. They made it look like, I think in this case they made it look like they had all these earnings and they were actually like at a loss for that quarter. And again, just so many more examples with big manipulation of income, making it look higher than normal, even when the company is losing money. Like one-off events, like they sell out a building, they get a bunch of money for it. It's like, oh, that's income. Yeah, so I imagine there might be more regulation these days to help protect investors to some degree. But I do know as well that there's plenty of manipulation that goes on. Especially, you have to be careful, I think, that I've mentioned in other videos of other countries, particularly China. The auditing over there is suspicious, to say the least. But anyway, so yeah, and then non-recurring losses from various sales or reduction of value of assets. This can affect the earnings too, and you need to, it's important to understand when this happens, is that when it's a one-time event, or a continuing event, that you have to realize that I think the bigger point here is that when you buy stock of a company, you have to realize that they own a lot of assets, and a lot of times those assets can be risky assets, and they can change in value over time. You can have a company that for some reason has a room full of gold, and if gold goes up, the value of the company goes up. And if it goes down, the value of the company goes down. And the same thing can be said for real estate, silver, Bitcoin in particular is a pretty big one for a lot of these new Bitcoin mining and companies, and places where you can trade Bitcoin and other cryptocurrencies. Those are obviously on parts of the assets of the company. Or if they own Tbonds, in particular with banks, backing up their depositors with Tbonds. They own lots of Tbonds, and if long interest rates go up, as we've seen very recently, that's the reason all these mid-sized banks collapsed. If you were really paying attention and you knew this stuff ahead of time, you could have seen this coming very easily, right? So like a lot of banks hold a lot of treasury bonds, and when everyone was getting the stimulus money and putting it in their bank, the banks, they weren't lending that much, and when they're not lending as much, they have to lend it somewhere. So what they end up doing is they buy T-bonds, and they were buying T-bonds at a very, very low yield. 0.7, I think, percent. It got down to at its lowest for the 30-year bond. So you have these banks loading up on these treasuries, and now, inflation takes off. So as soon as you saw inflation taking off and the 30-year yield bond going up, that should have been an easy sign to start like shorting banks or buying puts on banks. I mean, that in retrospect, of course, everything in retrospect is pretty clear, right? Everybody understands what happened after it happened. the the trick is seeing, looking through the looking glass and seeing what's next. I don't want to digress too much here, but Michael Burry owning, supposedly rumored 10 to 20% of his entire net worth in puts on SPY right now is a little concerning. Makes me wonder if I should get one or something to hedge my my accounts. But anyway, I digress. So then we go on to, as I said before, he talks a lot about investment trusts, and I believe this was before the Investment Company Act of 1940, I think, because he has all these issues with it. And like I said, these things have changed over time. But I still do wonder if, like, even like a fund like Berkshire Hathaway, can have things going on that are manipulative. I think most funds are pretty translucent. Like, that's not the right word. You can see what's going on pretty easily. I don't think they try to trick people, especially not as much as it sounds like they did before, especially leading up to the Great Depression and then up until 1940 when they enacted that act. So next point. So on the flip side, very important, on the flip side of, I always think about the loss of value of things affecting the value of the company, fairly or unfairly, right? Like, if they can hold on to the assets until the assets go back up, then the company still has the same earning power, kind of, if they're not selling those assets, they're just holding them. Or if they're not forced to sell them, like what happened with those mid-sized banks. But there's another side of the coin. Overvaluation can happen as well. And so when you have the assets of companies that are, going wildly high, all of a sudden the earnings look like really stellar, until, you realize how much volatility there is in what they have, including securities, not just treasury bonds, any securities that they're holding of anything. So he says this is particularly a problem with investment trusts, but also especially with banks and insurance. And a big part of this that he actually says specifically, basically, retail investors should not invest in insurance companies or banks. He says that flat out. And he says this because he says, in his words, it takes a lot of digging, and it's too much for, small town Joe to be able to handle the complexity involved with the asset values of banks and insurance companies. So I found that extremely interesting. As someone that likes to invest in index funds, I like to try to, see, where we are in the cycles, and, financials can do well, and you just buy all the banks together in an index, and he might even approve of that. But, this is more about individual stocks. I've thought about buying bank stocks before and insurance stocks, and I've stayed away from them because they were confusing. So I guess this is him just confirming my bias that I already have. Go me. All right, and then we're almost done with this chapter. We have a section where he talks about there's some profits that companies are claiming of corporations when they're buying their own senior debt at discount. So, like, say the corporate, let's say all corporate debt is like going down in price and becoming undervalued, and they smartly, buy a bunch of their debt that's sitting out there because it's cheaper now. People are selling it. Well, okay, now we don't owe as much. We're buying it back. But he says that this is also what they're doing sometimes is manipulating the income statement by doing this as well, and shows just so many examples. Well, for that one, I think maybe 2 examples. Not sure. Doesn't matter. Then the next one, the last point he makes is that most other non-recurrent profits that were not mentioned from other sources, he says, are of minor consequence, he says, usually. I think there are some more rare cases where something goes haywire and whatever, and so I think that's what that was all about. So again, to wrap up in a nutshell, don't buy bank stocks, don't buy insurance company stocks, and don't trust earnings by itself. Be skeptical and be careful, because the accountants can manipulate what you think. Reminds me of one other example in the chapter. It was 2 tire companies, I think he compared to each other, that manipulated their earnings. Oh, no, that's the next chapter. That's all for, we'll see you next time in chapter 32. This was chapter 31. Thank you for watching. Rob's Child.